Hi, my name is Claudia, and today we'll be providing you with a short tutorial on the matching principle. The matching principle is one of three accounting principles, the other two being revenue recognition and cost. To begin, let's first define what is meant by the term expenses. Expenses are a decrease in assets resulting from selling a good or providing a service. Expenses are recorded on the income statement. So how do expenses relate to the matching principle? Well, the matching principle determines that expenses are recorded in the time period they are incurred to generate revenues, regardless of when the cash transfer occurred. Because of this, the matching principle is associated with the accrual method of accounting and adjusting entries. There are two scenarios in which the matching principle is applied. The first is deferred expenses, which occurs when a company will pay for a resource before it uses it or consumes it. The second is called accrued expenses, which occurs when a company will incur an expense and pay for it later. Now let's look at some examples of where these scenarios can be applied. Deferred expenses. On February 1st, Sally's seafood shop purchases a 12-month insurance policy for $48,000. Because the insurance has not yet been incurred, it is recorded in the journal entry as an asset. This is the prepaid insurance account, which is debited at an amount of $48,000. Then the cash account is credited at an equal amount of $48,000 in the same journal entry. This is to demonstrate that the company's cash is decreased by the amount of insurance brought, offsetting the increase and decrease in assets. Now, at the end of February, the company has used 1 month worth of its insurance, which equals $4,000. This is acknowledged by debiting the insurance expense account by $4,000 and then crediting the prepaid insurance account by $4,000 as well. The insurance expense is increased by the amount of insurance consumed during the period, whereas the prepaid insurance account is decreased by the same amount. Hence, the expense incurred is matched to the appropriate time period. Number 2, accrued expenses. Now let's suppose that Sally's seafood shop payroll for the month of February is $5,000. Sally pays her employees via deposit every Friday night for the work that employees have provided to the end of Thursday. Because the matching principle requires that expenses be recorded in the period they are incurred, Sally must record the $5,000 of expense on Thursday the 28th of February. This is recorded by debiting the company's salary expense account by $5,000 and is thus increased as the expense has been incurred. The salaries payable account is credited by the same amount of $5,000. This account is increased because Sally has not yet paid her employees. Now on Friday the 28th of February, when wages are paid and deposited into the employees' accounts, the salaries payable account is debited by $5,000 and the cash account is credited by the amount of $5,000 as well. Both the salaries payable and cash account are decreased as the salary expense has been paid. No